Over the last 2 weeks, one location has become the focal point of the global economy, the Strait of Hormuz. It's a narrow waterway between Iran and Oman that roughly 20% of the world's oil supply passes through every day. And right now, markets are watching it very closely. If the strait remains closed or disrupted, the immediate effect is higher oil prices and higher volatility in global markets. We've already seen oil move above $100 per barrel in short-term futures. But interestingly, longer-term oil prices remain much lower. Markets are still assuming this disruption will eventually resolve. That tells us something important. Right now, markets see this as a serious event, but not yet a long-term structural shock. The biggest economic pressure is actually outside the United States. Countries in Asia, including China, India, Japan, and South Korea, rely heavily on oil shipments through Hormuz, which means their economies are more vulnerable to supply disruptions. Europe also remains sensitive to energy shocks after the 2022 energy crisis. The US, on the other hand, is far less dependent on this route, which is one reason the US stock market has remained relatively resilient so far. History shows that when oil prices rise sharply, producers bring new supply online, consumers reduce demand, and markets begin adjusting surprisingly quickly. Energy shocks often look dramatic at first, but the global economy tends to adapt faster than headlines suggest. For investors, the key variable right now is time. If the situation resolves relatively quickly, markets are likely to stabilize. If the disruption lasts longer or escalates, we could see more pressure from inflation, interest rates, and energy prices. At Excelsior, we've always approached portfolios with diversification and downside protection in mind. Events like this remind us why that matters. We'll continue monitoring developments closely and adjusting strategy where needed. But for long-term investors, maintaining perspective is often the most valuable asset of all.